As the European Central Bank navigates the turbulent currents of inflation and economic growth, a chorus of voices from within its hallowed ranks are urging prudence and discretion. Among them is Boris Vujcic, that contemplative governor hailing from the sun-dappled shores of Croatia, a nation shaped by the ebb and flow of empires across the centuries. Vujcic speaks with the measured cadence of one who has seen economies wax and wane, prosperity bloom and recede like the tides. In the airy café where we convened, his words carried the weight of deep philosophical reflection. In order to do more, we need to see more, he intoned, the Adriatic itself shimmering through the window at his back. Any prolongation of the inflation conversion toward the medium-term target weakens the case for an interest rate cut, and vice versa. His utterance encapsulated the delicate calibrations that will guide the ECB's next move on interest rates, come September. The bank's deft maneuver in June, lowering rates by a quarter point, was a masterful gambit, a single, precisely weighed pebble that sent ripples across the monetary pond. But the fundamental question remains, to slash or pause? Vujcic's judicious counsel leans toward the latter, at least for now. July is always an option, but much more data will be available in September, he measured. Everything is open at that meeting, a pause or a cut. I don't want to show any signals of what we want to do before we see more data. The Governing Council's fresh projections in June offered a glimmer of respite, slightly faster inflation this year and next, edging tentatively closer to that hallowed 2% target. But the path ahead remains uncharted, fraught with the spectral anxieties of lagging growth and resurgent price pressures. From his Baltic remove, Martin's Kazakhs, Vujcic's Latvian counterpart, struck a harmonious chord. Policymakers mustn't allow inflation to remain above 2% into 2026, the monetary sage asserted, aligning with the ECB's aspiration to reach that milestone in the waning days of 2024. This refrain is fast becoming the governing melody within the ECB's cloistered chambers. Mario Centeno of Portugal lilted that inflation shall remain at a plateau until August, advocating for a poetry of prudence. Bojan Vasil of Slovenia echoed in kind, vowing rates shan't be lowered with the same alacrity they were hoisted. For Vujcic, the prime uncertainties swirl within the nebulous realm of services inflation, less tradable and more wage-sensitive, as he characterized it with a furrowed brow. Could this stubborn dimension of consumer demand presage a more permanent change in preferences from goods to services? I don't have an answer now, but we'll find out in due time, he allowed, raising an inquisitive eyebrow and leaving the philosophical quandary to linger luxuriously over our table like the aroma of strong coffee. While the baseline ECB forecasts sketch a trajectory toward that sacred 2% inflection point, Vujcic insisted the Guardians need to keep a special eye on services. The upside risks to that coveted outlook, while balanced for now, could yet materialize as the services momentum outpaces projections. As our discussion ambled toward its cogent conclusion, the Croatian sage offered one final, encapsulating pearl: a much faster decline in inflation isn't very likely because it could primarily happen via goods. With that sober assessment, Vujcic arose, folded his linen napkin with practiced precision, and departed into the seaside splendor of Dubrovnik's ancient ramparts. The future paths of ECB policy became manifest, plotted cautiously by economists who move in complicated calibrations, alive to nuance, unruffled by the transient squalls of data, and forever in pursuit of that elusive, enchanted target of 2%. The doves and hawks of Frankfurt may flap their wings, but the monetary waters will be stilled only by pragmatic navigators possessed of Vujcic's unflappable equanimity, for in the timeless eddies of the economic main, prudence is a virtue that never ebbs.